Welcome to Wealth Chapters, the channel where we break down the most powerful books on wealth, investing, and personal growth, one chapter at a time. Chapter 19, Shareholders and Managements. Chapter 19 explores the relationship between shareholders and corporate management. It discusses issues of governance, accountability, and alignment of interests. The chapter emphasizes the importance of evaluating management behavior rather than relying solely on reported results. Another theme is protection of shareholder interests. Investors are encouraged to remain aware of decisions that affect ownership rights and long-term value. So today, we're really digging into a huge question for any investor. Are you just along for the ride as a shareholder, or are you a true owner? It's all about figuring out who's really running the show and, more importantly, if they're running it for you.
You know, at the very heart of investing, there's this built-in tension, a fundamental conflict we can call the owner's dilemma. See, when you buy a stock, you're not just buying some ticker symbol that flashes on a screen. You are becoming a part owner of a real business. But, and this is the big but, you own it, but you don't actually run it.
Let me put it another way. Imagine you're a silent partner in your friend's amazing new coffee shop. You put up the cash to get it started, so you own a piece of the pie. But your friend is the one behind the counter every day, choosing the beans, hiring the staff, making all the calls. Now, are they focused on growing the business for the long haul for both of you? Or are they maybe using company money to buy a fancy new espresso machine for their own kitchen? Well, that's the exact same tension that exists between you, the shareholder, and the management team running the company you've invested in.
And that's the core problem, right? On one side, you have us, the shareholders. Our goal is pretty simple. We want the business to grow strong and create real, lasting value. We want the tree to grow for years and years. But on the other side, management might have a totally different set of priorities. They could be chasing short-term moves that pump up their annual bonus. Or maybe they're just focused on empire building, making the company bigger just for the sake of being bigger. Or they could just be trying to protect their own job, which might mean they avoid taking smart risks that would actually benefit you, the owner.
Okay, so if we can't just assume management is always working in our best interest, how in the world are we supposed to judge their performance? I mean, it is so tempting to just look at the stock price. If it's going up, they must be doing a great job, right? Well, according to the father of value investing, Benjamin Graham, it is absolutely not that simple.
Just let that sink in for a second. This quote from Graham is such a critical warning. A rising stock price or glowing quarterly reports can be a total smokescreen. A management team could be making really reckless decisions, taking on way too much debt, or cutting back on essential research and development, all just to make the next quarter's numbers look fantastic. The results look great now, but they could be planting the seeds for future disaster.
And this brings us to the real key of this chapter. We have to learn to evaluate management's behavior. This means we've got to look past the flashy numbers on the spreadsheet and really scrutinize the actual decisions they're making. Are they investing the company's money wisely? Are they treating shareholders like real partners? Are their policies built to create value that will last for a decade? Or are they just playing a short-term game?
So what does this actually look like in the real world? How do we put on our detective hats and start analyzing these behaviors? Well, let's open up a practical toolkit that every intelligent investor needs.
All right, here are 4 huge areas to keep your eyes on. First up, governance and accountability. Basically, is there a strong, independent board of directors keeping an eye on the CEO? This is your first line of defense. Second, alignment of interests. Does management actually own a lot of company stock themselves? I mean, when they have real skin in the game, their goals are way more likely to line up with yours. Third, transparency. Are they being open and honest with you, or are they burying bad news in pages of confusing corporate jargon? And finally, protection of long-term value. Are they smartly reinvesting profits back into the business, or are they just chasing the latest short-term fad?
Now, watching and judging is one thing, but as an owner, you also have rights and responsibilities. It's not enough to be a passive spectator. You've got to be ready to actually defend your stake in the company. The real question is, how do you do that?
Here is a simple 3-step playbook. First, read the fine print. Seriously, especially those annual proxy statements. That's where you find all the juicy details about executive pay and other key decisions. Second, question anything that's dilutive. That's when a company issues a ton of new stock, which can make your existing shares less valuable. It's like adding more and more water to the soup. It just gets weaker. And third, and this is so important, use your vote. Don't just toss that ballot in the trash. It is your #1 tool for having a say in the company you partly own.
When you really boil it all down, all of these ideas about judging behavior, watching for red flags, defending your rights, it all comes down to one fundamental shift in your mindset.
That's it. It's the shift from being a spectator who just bought a ticket to watch the game to being a part owner of the team itself. When you're an owner, you care about the long-term health of the franchise, the quality of the coaches, and the strategy for the seasons to come, not just the final score of a single game. This is probably the single most important takeaway.
And so I'll leave you with this one critical question to think about. I want you to look at the companies in your own portfolio. Go beyond the stock charts and the headlines for a minute, and ask yourself, based on their actual actions, their policies, and how they communicate, is the management of your investments truly, genuinely aligned with you, the owner?